Goldman Sachs just revised their silver price target, and the new number is forcing every institutional analyst who covers precious metals to completely recalibrate their models. According to a research note published less than an hour ago by Goldman's Commodity Research Division, the investment bank has raised its 12-month silver price target to $95 per ounce. That's not a typo, 95. To put that in perspective, their previous target published in December 2025 was $42 per ounce. This isn't a minor adjustment. This is a 126% increase in projected upside from current levels around 76 Rs. Goldman Sachs doesn't make casual revisions of this magnitude. When the most influential commodity desk on Wall Street more than doubles a price target in a single update, something fundamental has changed in their underlying assumptions. And when you read past the headline number into the actual methodology behind this revision, what's changed is not what most people think. This isn't about inflation. This isn't about geopolitical tension. And this isn't even primarily about the BRICS currency launch that happened 3 months ago. The catalyst Goldman is pricing in is something most retail investors don't even have on their radar yet. If you hold physical silver miners or any exposure to precious metals, your position just got validated by one of the most conservative research desks in institutional finance. But if you're like most intelligent investors, you're not just celebrating. You're asking the right questions. Why now? What data did Goldman see that changed their model this dramatically? Is this target based on supply-demand fundamentals, or is it a momentum chase after silver's recent run? And most importantly, does Goldman's track record on commodity calls actually justify the confidence the market is about to place in this target? Because here's what the headlines celebrating this revision won't tell you. Goldman Sachs has made spectacularly wrong commodity calls before. In 2011, they predicted oil would hit $200 per barrel. It peaked at $115 and then collapsed. In 2018, they called for $100 gold. Gold dropped below $200 within 6 months. Wall Street research desks are not oracles. They're analysts with access to good data and institutional biases like everyone else. So, the question isn't whether Goldman raised their target. That's confirmed. The question is whether their methodology is sound, what assumptions are driving the number, and whether those assumptions are likely to hold through the 12-month projection window. Those are the questions we're going to answer. By the end of this video, you'll understand exactly what changed in Goldman's model, what 3 specific data points drove the revision, and why their previous target was so dramatically wrong. I'm also going to show you the one time Goldman made a similarly aggressive precious metals revision, what happened next, and what that historical pattern suggests about how markets actually respond to these kinds of targets. But I'm also going to tell you the 3 reasons Goldman's $95 target might be too conservative, and the 3 reasons it might be completely unreachable. Because Money Untold doesn't do hype, and we don't do fear, we do analysis. Hit subscribe and turn on notifications, so you're first to know when I follow up on this as the story develops. Now let's break down what actually happened. Let me start with what the research note actually says, because the headlines are already distorting the message. Goldman Sachs's commodity research team, led by their head of metals research, published a 47-page report this morning titled Silver Supply Deficit Structural Shortage in the Photovoltaic Era. The $95 price target appears on page 3, but the real story is in the supporting analysis. Here's what Goldman's model is actually based on. First, they're projecting a cumulative supply deficit of 670 million ounces over the next 3 years. That's not annual deficit. That's total deficit across 2026, 2027, and 2028. To put that number in context, the entire global silver market trades roughly 1 billion ounces annually across all uses, industrial investment, and jewelry. A 6 and 70 million ounce deficit would represent 67% of 1 year's total demand being unfulfilled by mine supply and recycling over a 3-year period. That's an enormous structural imbalance. Second, Goldman identifies solar panel manufacturing as the primary demand driver. According to their research, photovoltaic silver demand reached 340 million ounces in 2025, up from 160 million ounces in 2023. They're projecting that number hits 450 million ounces by 2028 as global solar installations accelerate under climate commitments. For perspective, total annual mine supply is around 840 million ounces. Solar alone would be consuming more than half of all newly mined silver within 2 years under Goldman's Scenario 3. And this is the part that's not getting enough attention. Goldman is modeling a complete breakdown in the recycling assumptions that have historically cushioned silver supply. Here's what I mean by that. For the past 2 decades, whenever silver prices spiked, recycling rates increased, higher prices incentivized consumers to sell old jewelry, industrial users to reclaim silver from manufacturing waste, and recyclers to process old electronics more aggressively. Goldman's analysis suggests that feedback loop is breaking. They cite 2 reasons. First, the majority of new demand growth is in solar panels, which have a 25-30-year lifespan. That silver is effectively locked away for decades. Second, many industrial applications now use such small quantities of silver per unit that recycling is economically unviable even at elevated prices. The combination of these three factors, massive projected deficit demand concentration in non-recyclable applications, and reduced price-responsive supply, is what drives their model to $95. Now here's the critical detail that separates this from a typical bullish research note. Goldman is not predicting $95 silver in a single price spike. They're modeling a gradual march higher over 12 months as the deficit becomes undeniable and industrial users begin panic buying to secure supply. Their quarterly targets are $80 by Q2 2026, $87 by Q3, and $95 by Q1 2027. That trajectory matters because it implies Goldman expects the deficit to worsen progressively, not resolve through price-induced supply response. If they're right about that mechanism, $95 might actually be conservative. If they're wrong, we could see a sharp correction long before the target is reached. Let me show you what's really driving this revision. Before we go deeper, I want to hear your initial reaction. Do you think Goldman's $95 target is realistic, conservative, or overly optimistic? Drop a comment too low, spot on, or too high. I'm genuinely curious how this community is reading this news because the comment section here often has better analysis than the mainstream coverage. All right, back to the breakdown. The real story here isn't that Goldman raised their target. It's what changed in their underlying assumptions between December 2025 and today. Let me show you the three specific data revisions that drove this update. Data revision 1, Chinese solar manufacturing capacity. In December, Goldman was modeling Chinese solar panel production capacity at 850 gigawatts annually by 2025. That estimate was based on announced construction projects and historical capacity utilization rates. In January 2026, the China Photovoltaic Industry Association released updated data showing actual capacity came online faster than projected. Current manufacturing capacity is already exceeding 900 gigawatt, and the projected 2027 number is now 1,100 gigawatt. Every gigawatt of solar capacity requires approximately 300,000 ounces of silver for panel production. The 250 gigawatt upward revision in capacity translates to 75 million additional ounces of annual silver demand. That single data point revision accounts for roughly one-third of Goldman's target increase. Data revision to mine supply. Disappointments. Goldman's December model assumed global mine supply would grow modestly in 2026, reaching about 870 million ounces, up from 840 million in 2025. What actually happened? Three major silver-producing mines in Mexico and Peru experienced significant production disruptions in Q4 2025 due to a combination of labor disputes, permitting delays, and lower than expected ore grades at newly opened deposits. The result projected 2026 mine supply got revised down to 825 million ounces, actually below 2025 levels. That's a 45 million ounce negative revision to the supply side of Goldman's equation. Demand up 75 million ounces, supply down 45 million ounces. You've just created a 120 million ounce swing in the annual deficit forecast. Data revision. 3 BRICS currency reserve accumulation. This is the piece that connects to our previous video on the BRICS silver-backed currency. In December, Goldman modeled minimal central bank silver demand, assuming the BRICS currency would use primarily gold backing with only token silver allocation. Since the actual launch in January 2026, reported silver purchases by BRICS central banks have exceeded initial projections by a factor of 3. China alone imported an additional 40 million ounces in January compared to historical averages, with most of that volume going directly to People's Bank of China reserves. If that accumulation rate continues, and Goldman's updated model assumes it does central bank demand, adds 120-150 million ounces annually to the demand side, a category that was essentially zero in previous models. When you add these 3 revisions together, you get the mathematical explanation for the target increase. But there's a deeper mechanism at work here. Goldman's previous models assumed silver markets function like most commodity markets. Price increases stimulate supply response and demand destruction until equilibrium is restored. What their updated analysis recognizes is that silver is increasingly functioning like a strategic resource rather than a pure commodity. When a solar manufacturer needs silver to fulfill a contracted installation, they can't substitute another material. When a central bank needs silver to back a currency commitment, they can't wait for lower prices. That shift from commodity to strategic resource is what breaks the normal supply-demand feedback loops. And when those feedback loops break, price discovery moves from gradual to violent. That's the real mechanism behind the 95 target. Now let me show you when Goldman has made similar calls before. If this breakdown is giving you actual insight into what's driving this revision, rather than just hype about the target number, do me a solid and hit that like button. It tells YouTube that Money Untold is worth showing to more people who want real analysis. Alright, now the historical parallel you need to understand. There is one specific precedent for Goldman making an aggressive precious metals revision like this. And what happened next is instructive. In September 2019, Goldman raised their 12-month gold price target from $1,225 to $1,600 per ounce, a 12% increase. At the time, gold was trading around $1,280. The revision was based on their analysis that central bank buying and negative real interest rates would drive sustained demand. The market's initial reaction, gold rallied 4% in the week, following the announcement hit $1,020 by October, then pulled back to $1,065 by November. Most investors who bought on the Goldman headline actually lost money in the short term. But here's what happened over the full 12-month target window. Gold reached $1,685 in January 2020, exceeding Goldman's target. Then CO hit gold initially crashed to $1,250 in March 2020 before ultimately reaching $2,070 by August 2020. The target was right directionally. The mechanism was correct, but the path was nothing like the smooth appreciation Goldman's quarterly targets implied. That pattern tells you something important about how to trade these research calls. Institutional research targets are not trading signals. They're medium-term thesis statements based on fundamental analysis. The market doesn't move in a straight line toward the target just because Goldman published a number. In fact, there's often a predictable pattern. Initial spike on the news profit taken by traders who are already positioned consolidation or pullback, then eventual grind toward the target as the fundamental thesis plays out. If that pattern holds for silver, we might see $80 in the next few weeks as the Goldman call circulates. Then a pullback to $72.75 as profit-taking hits before the actual structural deficit starts driving sustained moves higher later in 2026. Now let me show you the flip side when Goldman got it spectacularly wrong. In April 2011, Goldman issued a commodity supercycle report predicting oil would reach $200 per barrel by 2013 based on emerging market demand growth. Oil was at 110 at the time of the call. It peaked at 115 3 months later, then entered a multi-year decline, ultimately crashing below $50 by 2015. What did Goldman get wrong? They underestimated the supply response. U.S. shale production, which was in its infancy in 2011, exploded over the next 4 years. The demand thesis was correct, but the supply-side dynamics overwhelmed it. That's the risk scenario for the $95 silver call. If silver prices rise aggressively toward $90.95, does that incentivize enough mine production increases and recycling to flood the market with supply and crash prices? Or is silver genuinely different this time because of the non-recyclable solar demand and strategic reserve accumulation? Goldman's model says it's different. History says be careful assuming this time is different. That tension is what creates the 3 scenarios you need to understand. Let me walk through 3 distinct paths from here, and what each one means for positioning scenario 1. Goldman is too conservative. The supply deficit is actually worse than Goldman projects. Solar installations accelerate beyond current forecasts as energy prices stay elevated. BRIC central banks double down on silver accumulation. Recycling remains minimal. Industrial users panic and start securing multi-year supply contracts at any price. In this scenario, silver blows through $95 by mid-2026 and potentially reaches $120, $140 as shortage conditions become acute. We see physical delivery delays, premiums for physical metal spike above futures prices, and mining stocks multiply as investors realize there's no near-term supply solution. The key indicator to watch: physical premiums over spot price. If you start seeing $5, $10 premiums for retail silver when historical premiums are $2 or $3, it signals physical shortage is real. Scenario 2. Goldman missed the supply response. Silver's rally toward 80.85 triggers massive recycling from India, China, and industrial stockpiles. Several marginal mining projects that were uneconomic at $30 silver suddenly become viable at $80 Mexico, and Peru resolved their production issues faster than expected. Solar manufacturers find ways to reduce silver content per panel. The deficit. Goldman projects never fully materializes. By Q3 2026, its clear supply is catching up to demand. Silver peaks around $88, fails to reach $95, and then corrects sharply back towards $65 and $70 as the shortage narrative collapses. The key indicator: watch monthly mine production data from Mexico, Peru, and China. If production starts climbing above 2024-2025 levels by Q2 2026, the supply response is happening. Scenario 3. Volatility without resolution. This is what I think is most likely, and it's the scenario. Almost nobody is preparing for silver reaches Goldman's $95 target, but not smoothly. We get violent swings between $72 and $92 as conflicting data points hit the market. Some months show deficits, other months show surprise surpluses. BRICS buying is inconsistent. Solar demand grows, but not as explosively as projected. The structural deficit is real, but takes longer to fully manifest than Goldman's 12-month window. We end 2026 somewhere between $80 to $90, having touched $95 briefly, but failing to sustain it. The real move higher happens in 2027-2028 as the deficit compounds. In this scenario, traders get chopped up trying to time entries and exits. The real winners are patient accumulators who add on dips and hold through volatility. The key indicator: watch the monthly supply-demand data from the Silver Institute. If deficits are erratic rather than consistently widening, we're in the volatility scenario. Now here's what to actually do with this information. If you're positioning around Goldman's call, here are 5 specific things to monitor. Signal 1: physical versus paper prices. Watch the spread between physical retail silver and COMEX futures prices. If physical premiums start expanding significantly above historical norms, currently $2.03 per ounce, it indicates the deficit is showing up in real-world delivery, not just in models that would validate Goldman's thesis in real time. Signal 2: Chinese import data. China publishes monthly silver import data with a 1-month lag. If imports stay elevated above 150 million ounces annually, it confirms both solar demand and PBOC accumulation are real. If imports decline below 100 million ounces, Goldman's China demand thesis is cracking signal 3 solar industry silver consumption reports. The Solar Energy Industries Association publishes quarterly data on silver intensity ounces per megawatt in panel production. Watch whether manufacturers are successfully reducing silver content per panel. If silver intensity is declining faster than installation volume is growing, total solar silver demand could disappoint Signal 4 mining company guidance. Major silver producers like Pan American, Silver First Majestic, and FNILO will update production guidance over the next 2 months if they're raising production targets significantly. Supply response is coming if they're maintaining or lowering guidance. Goldman's supply-side thesis holds Signal 5. Goldman's monthly updates. Goldman publishes monthly commodity updates. Watch whether they maintain conviction in the 95 target or start walking it back. If they quietly reduce the target in future updates without much fanfare, it's a signal their model isn't playing out as expected. Now, the framework for actually positioning: if you're adding silver exposure, consider this approach. Don't chase the immediate spike. Goldman's call will likely push silver up in the short term, creating a temporary top. Wait for consolidation. If you're scaling into physical spread purchases across 3 months rather than buying all at once, you'll average out the volatility and reduce timing risk. If you're trading miners or silver ETFs, consider taking partial profits on short-term spikes and redeploying on pullbacks. The path to $95, if we get there, will not be straight. Most critically, have an exit plan for the scenario where this doesn't play out. If silver is still below $80 by Q3 year 2026, or if physical premiums collapse, or if Chinese imports drop sharply, Goldman's thesis is failing and you need to reassess. I'm not your financial advisor. This is not investment advice. This is a framework for thinking critically about a major research call instead of just reacting emotionally. So, here's where we are. Goldman Sachs just raised their silver target to $95 based on supply deficit projections, driven by solar demand, BRICS accumulation, and mine supply disappointments. The methodology is sound. The data revisions are real, but the track record on these aggressive commodity calls is mixed at best. This could be the call that's right. It could be the call that misses badly. Most likely it's directionally correct, but dramatically underestimates the volatility and timeline required to get there. The opportunity isn't in blindly following Goldman to $95. The opportunity is in understanding the mechanism, monitoring the signals that would validate or invalidate the thesis, and positioning in a way that captures upside while managing the very real risk of disappointment. That's what Money Untold is here for. Not hype, not fear, just the framework to think clearly about complex situations. If this analysis helped you process this news with more sophistication than the headline reactions you're seeing everywhere else, subscribe to the channel and turn on notifications. I'll be tracking every one of those 5 signals and updating you as the story develops. Drop a comment telling me which scenario you think plays out too conservative, too optimistic, or volatile chaos. I'll be in the comments discussing this with you. And if you want the deep dive on why solar silver demand is different from traditional industrial demand, I've got a video breaking down the technical aspects of photovoltaic manufacturing that explains why this demand is so difficult to replace. I'll link it in the description. Thanks for watching Money Untold. We cut through the hype, we respect your intelligence, and we'll see you in the next.